We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. It's all right there. It's all about you and retirement. Can I retire? Well, when can we retire? Are we going to be okay? Will my loved ones be okay if something happens to me? That's really what Brian and Brad and the team at Decker Retirement are all about, helping you put together a plan and a strategy for your retirement. They focus on income planning. Certainly, you have to have income to replace paychecks that are no longer coming in. Distribution planning, got to make that money last as long as you are here. So there's a lot going on when it comes to retirement. Brian, Brad, and the team at Decker Retirement here to help. 833-707-3030. If you'd like to sit down and have a conversation with them, 833-707-3030. And of course, you can always go to the website to learn more, DeckerRetirementPlanning.com. Offices in about 3 different states for Brian and the team. DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, there's about 12 different things you can download. So you do have that opportunity as well, including Brian's book on retirement, the Decker Approach book. So you all have that opportunity. So again, if you want any, or you can download any of it. You can download Brian's book, the Decker Approach. You can download any of the 12 items that are just there for your information, no cost to you whatsoever. And again, if you have questions, maybe you download some of it and then you have questions, you can certainly give the team a call at 833-707-3030. All right, Brian, what are you and Brad getting into today on Safer Retirement Radio?
We're going to talk about the timing of your retirement. It may be a plus, it may not be a plus. So, Brad, let's talk about the timing of my retirement, January 1 of 2000, and your retirement, March 31 of 2003. Is there a difference?
Huge difference. Yeah, night and day. I mean, it's the difference between having more than enough to last a lifetime and even leave behind quite an estate based on normal distribution standards, 4% rule style planning, versus literally running out of money and having to dust off a resume when a poorly timed market downturn actually takes someone out. So sequence of returns risk is everything. When you start to do withdrawals from a portfolio, it opens up a brand new set of risks that people don't really account for until it's too late.
Okay, Brad, let me give you some other dates. Not just, by the way, for listeners, January 1 of 2000 was right before the markets. The S&P dropped 50%. NASDAQ dropped 70% in that 3.5-year period. So if I retire right before that kind of a market hit and markets traded flat for 14 years, that's really tough to retire and not have any gain on your portfolio for 14 years. In fact, not only no gain, but you're pulling money from the account each year to finance and fund your retirement. There's been 4 times that the S&P has traded above a market valuation of 30 times trailing earnings. Once was 1929 and markets were flat for 17 years. The second was 1964 and markets were flat for 18 years. The third time was November of 1999, markets were flat for 14 years. The fourth time was November of 2021. We hit 32 times trailing earnings. Now, if history repeats 100 years of history, we are looking at a flat market where any passive investment strategy, buying and holding stocks, mutual funds, indexes, or ETFs, is at high risk of yielding a zero return over 10 to 15 years. Now, how we handle that is going to be another topic that we'll get to in today's radio session. But sequence of return risk is a big deal. So let's talk, Brad, about how we overcome that and be able to make money in a flat market cycle so that we minimize the sequence of return risk. So the first part, Brad, is differentiating, still big picture, between accumulation and distribution. So if I'm in my 20s, 30s, 40s, 50s, this is a no-brainer managing my money. I pick my portfolio, probably the SPY or VOO, which is the S&P 500 index, and every 2 weeks I put money in it. If markets drop 30, 40, 50%, no big deal. My income is coming from work, and I've got the 3 to 5 years, the time for the markets to recover. And I actually benefit from that market cycle because I'm adding money to a down market. I actually benefit. Now let's switch that. I'm 65. I'm retired. My portfolio that I'm drawing income from, big difference, now is down 30, 40, 50%, and I'm drawing income from it. The strategies you use to accumulate your portfolio to the end result of retirement are not the strategies you use to manage your money in retirement. There's many differences. Brad, let's talk about the principle of drawing money from a fluctuating account versus drawing money from principal guaranteed accounts. Hit that one first.
Yeah. So the way that I describe this to people that I'm meeting with when they're first sort of entering this stage that you mentioned where you're doing withdrawals, I have to really drive home the point that it's no longer just your average return that matters in retirement. It's when those returns take place. In some, if you suffer losses early on in retirement while you're drawing income, you're locking in those losses permanently. And that can cause a portfolio to run dry much faster. You're drawing a fixed percentage or a fixed dollar amount out of an account that has gone in the red, it's gone down. And think of this strategy for drawing income from principal guaranteed assets or holdings that don't lose money. Think of it like climbing a mountain and then climbing back down. Your accumulation phase is what you were saying, where you're building and growing your portfolio. You're adding to your financial asset base every single paycheck, basically. Your dollar cost averaging over 30 or sometimes 40 or 50 years. And if you think about weather as market issues, market storms, on the way up, the weather doesn't matter as much. You're feeling good, you're fine, you're just going to put one foot in front of the other. It's on the way down, where one wrong step along that pathway on the way down, those are what I think of as retirement withdrawals, is what could be devastating to a portfolio. So pulling money from a portfolio that is, or a portion of someone's assets that is protected or set up with a deliberate idea being withdrawals that specifically defends against losses or anticipates that markets aren't always going to behave favorably, is the name of the game when it comes to distribution strategies and helping overcome sequence of returns risk.
Okay, good. And Brad, I think there's 4 reasons that we draw income from laddered principal guaranteed accounts. The first is peace of mind. When you have laddered principal guaranteed accounts, China can invade Taiwan, markets can be in upheaval, and our clients don't lose a dime. Last big market drop in 2022, S&P down 19, NAS down 33, bonds were down 20. Safe money that bankers and brokers say to put your safe money in, bond funds were down 20% in 1 year. Our clients didn't lose a dime in their laddered principal guaranteed accounts in 2022. So markets can be in upheaval, and our clients have tremendous peace of mind, point 1. Point 2, in a laddered principal guaranteed accounts, where bucket 1 is a money market earning 4%, bucket 2 is a 3-year CD, bucket 3 is a 5-year CD, bucket 4 and 5 are 7 and 10-year. These are laddered principal guaranteed accounts. We're using compound interest, point 2, to our advantage, drawing from the lowest earning account first, allowing the higher earning accounts to grow and compound. Point 3 is in the 15 or 20 years that we draw down those laddered principal guaranteed accounts to zero, it gives 15 to 20 years for the risk money to grow and compound more than offset what they have drawn out. So it's a refill, it's a re-energizer, it's a replacement of funds where we shift in and move risk money to fund their next buckets, a bucket 6, a bucket 7. And then fourth and final, we are purposely very, very conservative in our numbers for estimation on the retirement plan. So bucket 1, we have at 1% when it's actually earning 4. Bucket 2 and 3 are 3 and 5 year CDs. We have 3 and 4% where both of those are earning 5% or better. And buckets 4 and 5, we have a 4% number there when the last 10-year averages are more than twice that. So we're ultra conservative, Brad, with our estimates there. So those are 4 reasons that we draw income from laddered principal guaranteed accounts. Again, this is part of a distribution strategy, very different from accumulation strategies that you use to get to retirement. These are actual strategies we use in retirement called distribution. So Brad, let's hit another point. If we're in a flat market cycle, what does the 4% rule do for us?
Yeah, I mean, 4% rule, when you're doing withdrawals from an account that isn't trending higher, you're just back in that scenario where you have that sequence of returns risk. 4% rule assumes that you're going to have some market volatility, but you're going to use a mixture of asset classes to help hedge away some of that. You have some exposure to bullish trends in the market, and you have a hedge against that with probably 40% of your assets not in the market, so that if there isn't any growth, you're not getting hit as bad, or if there's negative growth, you try not to get hit as bad. That's good in theory. The problem is that oftentimes that distinction between the 60% that's in equities and the 40% that's in usually fixed income or bonds or bond funds they're often directly correlated. It's called a correlation of 1. And this is where when things are really scary, that flight to safety actually ends up being a flight to cash or flight to money markets. And when you're pulling money out of an account using the 4% rule, you're sort of roughly estimating that markets behave with their long-term averages or long-term trends. And unfortunately, that is not how long-tail events work, or the black swan events that the people actually get really hit by. The rule itself came from a historical backtest under very specific and frankly unrealistic conditions. The 4% rule actually doesn't hold up well in a low interest rate environment. People saw that from 2009 all the way to 2022, when the Fed started to increase rates. 4% rule also really breaks down in market volatility. I mean, goodness, that's what the last 2 years has been. Even though it's generally positive, if you were to fall asleep on January 1st and wake up on December 31st and look at your portfolio, you'd see a positive return. But those yields have been earned. It's been a lot of ups and downs. And that's when the 4% rule, once again, just breaks down. I'll bring up one other thing about the 4% rule and the blended portfolio, the 60-40 that some people just adhere to, and unfortunately a lot of advisors adhere to, is the psychology behind how that portfolio operates can really be frustrating for folks. And the theory here is that I'll just stay invested and the market will recover. And I hear that resolution all the time because it's what people are drawing on from experience when they're 35, 45, 55, even 65. The problem is when you're 65 and you're drawing income from your portfolio, you're in a very different stage of your financial life. And then oftentimes people's behavior or their psychology with regards to their portfolio changes. And one of the things I love about how you laid out that bucket 1, 2, 3, 4, 5, I mean, you really need to be looking at a plan, one of our income plans, to get a better sense of what you're addressing there. But it breaks up people's portfolio into pieces that are now very easily addressed with an appropriate investment horizon. That risk bucket you were mentioning, so easy to go through a downturn and look at those holdings that might be exposed to market risk. But when people know that they're not used as a source of income for 7, 10, 15, maybe even 20 years out, those downturns that are going to happen multiple times are not going to affect our clients' income because of the way we're strategically structuring that portion of their plan to meet withdrawal requests.
So when you think about your retirement, there's no Brian, the team at Decker Retirement cannot guarantee you the markets will be perfect for you. So you need a strategy, which is what the team at Decker Retirement can do for you. Hopefully, they don't really know if they can help until you reach out. But you do have that opportunity every week on this program to call Brian and the team at Decker Retirement, have a conversation about your situation, your hopes and dreams for retirement. There is no cost for this whatsoever. There's no obligation. There's no pressure. And we're talking about the next 20 or 30 years of your life. It might be the most important phone call you make just to get some clarity into your retirement situation, get some understanding. All you have to do is give them a call, 833-707-3030. No cost, 833-707-3030. Take advantage of this opportunity, 833-707-3030. Brian and Brad Geddes back with more of Decker Retirement Planning right here on Safer Retirement Radio right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. You can always learn more on the website, DeckerRetirementPlanning.com. A whole lot of things you can download under the heading of Safer Retirement Education on that website as well. And if you have questions for Brian, Brad, and the team, anything financial, retirement related, give them a call and ask them. There's no cost. 833-707-3030, 833-707-3030. I'm Mark Kelly. Glad you're with us today. Brian and Brad, we're talking about sequence of returns risk, right, Brian, in that first segment?
Right. And Brad's got some numbers that are kind of interesting that illustrate this risk.
Yeah, I mean, it's the classic case of two brothers retiring 10 years apart from one another. One of them retires 1990, the other retires in 2000. And let's pretend that they both started that decade that they were hiring into with $500,000. And because they started with the same amount, let's assume that the same advisor would give them the same advice and recommend that they withdraw the same amount. We'll call it, let's say, $30,000 to kick these off. So over the course of that 10 years, from 2000 all the way to the end of 1999, brother one has drawn out, simple math, says $300,000 from that $500,000 portfolio. But his fortune was favorable. He ended up that 10-year time frame with more than he started with, substantially more. His portfolio was at $1.2 million as a result of favorable market conditions. And frankly, it was some of the most favorable market conditions in history, second to the post-2009 era. Now, if you enter the world of the second brother, $500,000 retiring 2000, spends a decade in retirement, draws the same $300,000 out over that time frame, 10 years at $30,000 a year. Fundamentally different outcomes. Brother number two is starting to have to really think hard about how much longer he's going to live or how he's going to start to replace his portfolio because he's down to, what was the number, $136,000 left in the $500,000 portfolio. And that just shows how the math behind the estimates tied to a sustainable withdrawal rate, assumptions around historical performance on a portfolio, and just extrapolating that going out and just blindly trusting those types of metrics without reflecting in the portfolio strategy that you are going to be doing withdrawals can end up in completely different outcomes, different scenarios. 1.2 million versus 136,000 at the end of 10 years.
That is stark. And so another way to illustrate the distribution plan versus accumulation plan is the ways that we in the distribution plan reduce risk. And the first way is quantitatively. Instead of these ridiculous 60, 40, 70, 30 portfolios that bankers and brokers recommend because they get paid more on the equity exposure and are not fiduciaries to their clients, we think that that's insane. We think it's way too much risk for someone who needs those funds to last for the rest of their lives to manage their portfolio. The way that we recommend is quantitatively lowering it from a 60 or 70% exposure to around 25 or 30. The second way that we reduce risk in client portfolios is we eliminate interest rate risk. Our clients have zero exposure to bond funds. It doesn't make sense to us to have bond funds that lose money in a rising interest rate environment to be holding bond funds in a rising interest rate environment. For example, the 10-year Treasury was at 2% in 1940, and for 40 years, it gradually increased to where it peaked out at around 15% in 1980, 40 years later. Then for 40 years, interest rates declined from 1980 to 2020. hitting a low on the 10-year Treasury of 0.47%. Once there was that kind of a low, anyone recommending bond funds when interest rates on the 10-year Treasury was almost zero was not doing anything in the best interest of their client, because the only way for that portfolio to go was to go against them and lose money. Because when interest rates were to go below zero, you would hold a portfolio that would cost you money. And if interest rates went up, then you would lose money. So at 0.47, it was a lose-lose situation. The third way that we reduce risk in a client portfolio, especially in a flat market environment, is strategically. So if we are hoping for the best but planning for the worst, then what we do is we are hoping for a market that goes up like it has been in the last 15 years. Probably not going to happen, but we hope that it will. And if it does, we participate and take advantage of it. But if not, we've discovered that there's two ways to make money in a flat market cycle. One is dividends, and the other is momentum. So on momentum is a function of relative strength. Relative strength scores all stocks, indexes, and ETFs from 0 to 100, and relative strength is a function of stock appreciation and volume. And momentum has you buying the top relative strength stocks until something better comes along and you rotate into that. It is sector rotation, it is momentum, it is relative strength. So for example, in 2000, 01, and 02, when the S&P lost 50%, NASDAQ was down 70%. During that 3-year period, there were many sectors of the market and individual stocks that made money while most people were losing half their money. Gold, silver, real estate through the REITs, energy, pharmaceuticals, biotech, healthcare, all those stocks made good money each year for the next 3 years while most people lost half their money. Then in March of 2003, markets bottomed, and what exploded to the upside for the next 4.5 years was semiconductors, technology, small caps, and emerging markets. They made a lot of money. Now, in 2008, that was a waterfall decline, so everything went down with the exception of Treasury bonds. Treasury bonds were up 22% in 2008. The models we use would have had a position in Treasury bonds, but not much else, because when markets are caving and going down very quickly, we have stop losses in place to raise cash as markets decline. That would have happened in 2008, in 2001, 02. It happened recently in April of this year when Trump announced the tariffs. Our portfolios went up to 70% in market cash while the markets went straight down. S&P was down as much as 70%. Our clients during that period dropped only 6%. So those are ways that we can help clients make money, cherry pick the best parts of the market when markets are going up, and also be able to make money in down markets by locating the sectors and the individual stocks going up in a down market. And so what we do is, those are the 3 ways that we lower risk. But Brad, back to another way that we diversify our clients in the ladder principal guaranteed accounts that we mentioned before in the previous segment is buckets 1, 2, and 3 are fixed rates. So they make money no matter what happens in the markets. Buckets 4 and 5 are variable rates. That's where we get our much higher rates, usually 2 times CD rates in buckets 4 and 5. We have the ability to do well if markets are trending higher because buckets 1, 2, and 3 are able to do well because those are fixed rate accounts. Buckets 4 and 5, they are principal guaranteed accounts with indexes that are invested and allocate daily between stocks, bonds, and commodities, 3 different markets on a daily basis. So in 2000, 01, and 02, when stocks got crushed, these indexes are able to do well because bonds and commodities did well. In 2008, stocks and commodities were crushed, but bonds did well. So there are markets where we are hoping for the best going forward, but we are planning for the worst, such that if markets do go flat and we have a lot of volatility, we have the strategies in place to significantly lower market risk because we are quantitatively exposing our clients to much less risk, and we have eliminated a lot of the other risks that hurt clients in retirement. Brad, what else would you add?
Yeah, I think everything you'd said is 100% straight out of the plans that we pull together for our clients. I mean, it's right at the core of Decker Retirement Planning's overall approach towards portfolio management through some of the most sensitive years of someone's life. We just take it for granted that someone accumulated a lifetime set of savings, not just to have it positioned to probably have them be safely drawing money over the course of their lifetime. And I mean, probable in like a statistical sense, but they actually want it to help them accomplish what it was that they saved this for. And in a lot of cases, it's income certainty or cash flow certainty. A lot of them want to make certain that they, just as simple as stay retired. And unfortunately, they're getting bad advice. They're getting bad advice rooted in some planning, some planning tools that are very commonly accepted, but end up maintaining full risk forward portfolios that just maybe they have a little bit fewer equities in their portfolio, but they don't talk. Other advisors are not talking to their clients the way that we are, where we are recommending a systematic harvesting of a portfolio from very specific allocations that are meant to distribute funds in a regular basis through various market conditions. You mentioned the fixed rates that people have to be able to harvest from. Well, that's awesome. In a year where markets are just not doing well, we have those guaranteed growth vehicles for accumulation when everyone else is losing funds. We have other pieces of the portfolio from the risk bucket and the momentum strategies and dividends all the way down to index strategies where they have sort of the best of both worlds. I mean, it really comes down to building that portfolio to reflect how you're going to use it. And that's what I think we do better than anyone else.
Hey, just so you guys know that there is no doubt the Decker Retirement Planning team has live events in Seattle. They have live events in the Salt Lake City area as well. You can just go to the website, deckerretirementplanning.com, deckerretirementplanning.com, find out when the events are, where they are, what's the topic, find out more information. If you'd like to sign up, you can sign up right there, deckerretirementplanning.com. Also, if you'd like the toolkit, do you want the free toolkit? Just call them and say, hey, I've heard Brian and Brad on the radio. They're talking about all the stuff that they offer to potential clients or their own clients, obviously. I would like that toolkit. Give me an idea about retirement. 833-707-3030. And of course, you can just call that number and say, hey, I got some questions. I'd like to sit down with the team. No cost to you. 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us here on Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. 833-707-3030 if you have any questions. Boy, I wonder if I can retire. I think I've done enough. I think we're going to be okay, but you don't really know. Take advantage. Talk with the team at Decker Retirement about your situation. They're here to help if they can. 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us. Brian, you and Brad were talking about what? Going to Vegas, doing some gambling, Monte Carlo or something like that?
Yeah, there's a Monte Carlo report that gives you a percentage success ratio. Brad, talk about the Monte Carlo. How would you feel if I was your advisor, Brad, and I said, well, you've got about an 80% chance of success in retirement, Brad? How would you feel? Talk to radio listeners about the Monte Carlo before we cover one more topic, and then we're going to spend the second half of this radio show talking about the big, beautiful bill and the benefits that are out there for retirees.
Yeah, so I think first, before I ever address Monte Carlo, I have to make sure I'm explaining what it is that I'm talking about there, because oftentimes advisors are not sharing with their clients exact names. It's a statistical technique. It's used well. Monte Carlo simulation is a statistical technique that's used well beyond the world of finance. It just happens to be used quite often in the world of financial advisory when people ask the question, am I spending too much? Or how much can I spend out of my current portfolio? And a Monte Carlo simulation is a way of running that particular withdrawal rate, say, $10,000 a month, $5,000 a month, $20,000 a month, however much someone is pulling from their portfolio in a single monthly basis or annual basis, you can run that against their portfolio returns over history. And you can see how many times out of 10,000 would that client have ended up in a position where they have overspent and AKA run out of money, or how many times out of 10,000 have they ended up successful. And a good Monte Carlo simulation will have, let's say, 90% of the times over the course of history will result in a successful outcome. Someone has more money than what they needed, and they pass away, and they leave behind a nice little inheritance for kids. I call that a top-down approach. It's a portfolio-driven approach. It's where my portfolio basically tells me you can use your assets in this manner based on historical simulations and assumptions. At our firm, as you know, Brian, we go the other way, and I think of it as bottoms up. And this is where the term principal guaranteed comes from. This is where we're using tools, asset classes, a particular withdrawal order to maximize someone's cash flow, coming from the standpoint that it would be unacceptable for us to have a scenario where a market crash wipes out our client's ability to be able to continue to withdraw safely. Now, Monte Carlo simulation, any questions on that so far, Brian, or comments there before I just walk through some of the disadvantages that I've come across?
No, just keep going, Brad.
Yeah. So the Monte Carlo, the reason it's so important that people understand this is because you have to keep an eye out for it. For more generalist financial advisors that are out there that are focused more on your pie chart or your risk tolerance, and you have a little pie chart sitting there and to talk to you about economic conditions and sort of we'll do a 4% withdrawal rate. The problem starts with this approach from the fact that there is no downside protection at all. In fact, maybe they might have 1 or 2 or 3% of the portfolio sitting in cash, but really every asset they're using is some form of at-risk security. There is no protection. There is no floor. There is full market risk exposure to your equities. There's market risk and interest rate risk to your bond funds. You can lose across the board. To me, it's like running a crash test on a car. The crash tests are pretty helpful in theory, but it's not going to stop the car from crashing if you are actually in an accident. It's sort of hoping that the metrics continue to play out in your favor. Monte Carlo simulations are completely exposed to sequence of returns risk. There is not going to be an average return profile for your portfolio. In fact, I would wager that you will have precisely not the average over the course of someone's lifetime. The average is just the expected return, but the known return is going to be outside of that on one way or the other. You might assume a range of possible outcomes, but if a retiree experiences a bad sequence of returns early on, they might have been 94% likely to be successful in the end, but guess where they ended up? They're on the 6% side of that, in which case they've run out of money and there's nothing we can do about it. The other one that I think to me is the final conclusion, and well, I think it is actually the most important that I would even put in front of an advisor. I'd say, why the heck do you think this works? And it's because the success rate sounds good, but if you flip the terms to failure rate, sometimes it triggers a little bit different emotion. So if I told someone, hey, you're going to be 90% likely with this portfolio configuration, and with your withdrawal rate, 90% of the time you're going to be fine. What are you at? You're in an A minus kind of territory. But if you flip that, that means that 1 in 10 of my clients, if I was using that approach, and it's espoused by so many different advisors that are at the big banks and big brokerages, 1 in 10 are going to run out of money. A completely unacceptable statistic. Even if it was 1 in 20, a 95% likelihood of being okay, right? That sounds good, but it means 1 in 20 of that portfolio approach are actually going to run out of money. There's a confidence bias that comes from this presumption of statistical analysis confirming that someone's going to be okay in the end. But the reality is that they're not nearly as safe as people think, especially when the outcome is something as irreversible as running out of money. So I sometimes have people that come through and they bring in their report from their advisors. Say, hey, I've got a really good advisor. I probably don't need your help. I just want you to double check some things. We'll go through and I'll be like, this is not what you think it is. And a couple others about the Monte Carlo simulation that I think are actually more like tactical. So this was addressing was some of the strategic aspects to the Monte Carlo simulation, some of just the fundamental issues, but more tactically, when you're living with the Monte Carlo approach, remember, you are probably going to be okay. 9 times out of 10, you'll probably be okay. However, the model itself is extremely, extremely sensitive to the assumptions that are fed into the model. Return expectations, those deviate, especially over substantial periods of time. If they deviate from the long-term return expectations, your model will fail or be more successful than you originally thought. If inflation rates end up being higher than what someone's expecting, this assumption was wrong and will mean that someone is probably going to be more likely to run out of money than what their Monte Carlo simulation suggests. The assumptions, the reliance on those assumptions being accurate over the course of a 40-year time horizon of withdrawals makes a Monte Carlo simulation quite questionable for me when you realize that exactly the opposite is true of the average. The average won't happen. It'll be something else besides the average. I think just two more that I'll bring up. When it comes to the Monte Carlo simulation, one thing that I love about how we structure portfolios, I've been sitting across my clients during good years, during rougher years, the market's a little scary, a little bit more volatility. I love that it creates a psychological buffer to be harvesting from a portfolio that is specifically meant, first and foremost, to distribute cash flow through mixed markets. Markets that are trending up, great. We're pulling for. Markets are crashing, trending lower. Well, no problem. Nothing's changed. We're drawing principal guaranteed accounts. And that psychological buffer of having a portfolio set up for withdrawals from principal guaranteed assets allows us to stay the course on that risk bucket. There's no need for panic in April of this year when markets were not doing great with Liberation Day and the tariffs that were causing a lot of uncertainty. If anything, it was a time to buy more. It was time to allocate more to the risk bucket. It wasn't scary because it wasn't affecting your safe money. And then lastly, I think kind of the opposite of that, of that psychological buffer it's provided. The Monte Carlo simulation really doesn't allow you to have a structured source of income. You know the rough percentage, based on historical results and assumptions going forward, that you can draw reasonably or statistically draw a certain amount of income every single year, but it provides very little instruction as to where it's drawn. And the question you have to ask yourself or ask your advisor at the end of the year is, do we sell our winners? Those have done really well. Do we take some profit, or maybe we cut some of these dogs? I mean, these assets are performing poorly. Let's keep more of the winners in place. And that kind of feeling your way through retirement, it just isn't good enough. A Monte Carlo simulation helps you plan for the future. It's a great way for people to build and grow and save up for something 10 or 20 or 30 years down the road, but it's not going to protect you, and precisely not going to protect you right when that protection is needed. It gives you the probability and that you'll be maybe okay, probably okay, but there's absolutely no guarantee. There is no protection. There is no downside defenses against losses. And so when people are actually drawing money from their portfolio, I would argue that the stakes are simply too high. The risk of failure is not just acceptable if it's less than 4%, it's unacceptable under any situation. And so you want to try to minimize that risk at all. So sorry for being a little long-winded there, but there's a handful of things that I really despise about the Monte Carlo simulation and the general acceptance across the board in the financial industry that I think should be improved.
Okay, now, Brad, let's transition over to the OBBB, One Big Beautiful Bill, and talk about the tax credits for seniors. The first is the expanded tax credits for seniors 65 and older, targeting a situation where they no longer pay taxes on Social Security. Now, Social Security never went tax-free. What happened is they gave tax credits, which phase out for incomes joint, 150,000 to 250,000 AGI, adjusted gross income, and they gave $6,000 in tax credits to individuals, 12,000 per couple, so that 88% of Americans would have no taxes owed on their Social Security. That's how they did it. There was another $2,000 credit, so now it's up to $8,000 per person, 65 and older. And that tax credit is for AGI, adjusted gross incomes of 150,000 and below, and it's phased out to zero for AGI, adjusted gross incomes joint for 150 to 250,000. That $8,000 is above and beyond the standard deduction that comes to people and couples. And in our next segment, we want to talk in more detail about Medicare, Medicaid, Social Security, housing support for seniors, nutritional assistance, long-term care, workforce investments, talk about the Trump accounts that come to newborns. We'll cover all that in our next and final segment.
So if you have questions, you want to sit down and learn about how this affects you, because at the end of the day, that's what it's all about. Can you retire? Can you make sure that your money will last as long as you need it? Can you do the things you want to do with the people you want to do when you want to do them? That's really, at the end of the day, what a retirement plan is all about, giving you some clarity into that situation, giving you some direction, maybe giving you the permission to take that trip, get that car, whatever it is. But you need to know where you are when it comes to that retirement picture. 833-707-3030. And again, you can call that number if you just like the toolkit as well. Just call that number and say, hey, I'd love to get the toolkit I heard about on the radio. 833-707-3030. 833-707-3030. Brian, Jay, and Brad going to wrap it all up right here on Safer Retirement Radio in our final segment. That's coming up next. Stay with us. We're back right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I always tell you on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education, there's 12 different things you can download, including Brian's book on retirement, the Decker Approach book, 3 Principles of Retirement book, the Checklist Challenges Sample Income Plan. Those are just 4 of the 12 things available for you to download off the website. There's no cost. Grab what you want. If you have questions, you can always call a team. Decker Retirement, 833-707-3030, 833-707-3030. All right, Brian, where are you and Brad going for this final segment?
Well, in the final segment, we're going to talk in detail about the One Big Beautiful Bill and the benefits that have come out for seniors 65 and older. We talked real quickly in the last segment about the tax credits extended to seniors 65 and older. These are $6,000 credits with an additional $2,000 attached. That's above and beyond the standard deduction that applies. So you've got $8,000 per person for couples that are joint. That's $16,000, and that is phased out for AGI, adjusted gross incomes of $150,000 to $250,000. So AGIs of $250,000 and above, all of this credit is gone. AGIs of $150,000 and below, all of the $8,000 per person is received. There's also prescription drug cost reductions. Building on the Inflation Reduction Act changes, it caps out-of-pocket drug costs for Medicare beneficiaries at $2,000 a year. That's huge. It expands Medicare's ability to negotiate prices. That's huge. And it reduces insulin costs to $35 a month maximum. Now, I know some friends that have diabetes, and that's saving about 4x. Medicare and Medicaid enhancements, expanded coverage for hearing aids, dental and vision care. It increases Medicaid funding to improve nursing home oversight and quality. We're mentioning these things so that if you go online and check these things out, if any one of these things perks your ear, you can jot a note and check out more information on them. Housing support for seniors. Funds have come to increase the availability of affordable housing for seniors on fixed income. It's the expansion of Section 202 Housing Code. There's nutritional assistance, boosted funding for Meals on Wheels, and similar senior nutrition programs. There's much easier access and enrollment in SNAP, which is the food assistance program for low-income seniors. There's long-term care workforce investments. So this addresses the caregiver shortage in home and community-based services. It includes better wages and training for long-term care workers, makes it easier for retirees to stay home instead of entering nursing homes. And finally, I'll just hit the Social Security protections. While the OBB doesn't directly expand Social Security benefits, it does pledge to protect their current structure and solvency. It rejects cuts to Social Security and Medicare in any future budget negotiations. So there's been a big fear out there about that for seniors 65 and older about budget cuts to Social Security and Medicare. The OBBB has in place, and now it's passed and part of law, it rejects cuts to Social Security and Medicare in any future budget negotiations. Brad, what else would you add to that?
I think the two there is there's the bigger standard deduction that you mentioned. That's one I'm excited about. The other one for me in California as well is that SALT deduction, that increased cap on deducting state and local taxes. And I'm in California, so that is a one that was kind of a bummer before when that got reduced. And so coming back up to 40 grand instead of 10 grand is pretty helpful for a lot of my clients out here. And anyway, it's a pretty meaningful break in places like California and of course New York and stuff too. So the other one I think we don't want to miss is the child tax credit. That child tax credit of $2,200 per child is something that people should be making sure they're paying attention to, and it's a pretty big break there from this bill. I know it applies less for retirees, at least in a lot of cases, but I know a lot of my clients that have kids or that have grandkids, that can be an important one. The new, similar to that new Trump account, the $1,000 starter bonus, I think is how it was worded. That sounded kind of funny to me. For all babies that are born between 2025 and 2028. I have 3 kids of my own, and certainly wish this was underway back then, because it really does sort of kickstart that savings that's so important the younger someone is, and that can be added. It's something like up to $5,000, I think, a year that you can add to that in tax deferred contributions, so like an IRA for kids. And I just love that it's also tied to very specific spending requirements. I believe education was one of them, so that's good. Get a nice boost for the economy there as people invest in their knowledge. Of course, home purchases has always been a part of the American dream there, trying to help facilitate home affordability via good savings. But I think you can also use it for things like job training in the future.
And Brad, a couple other things about that Trump account. So $1,000 goes into the account from the Department of Treasury, children born 2025 through 2028. You're right. Parents and others will be able to contribute up to $5,000 a year in after-tax dollars up until the year before the beneficiary turns 18. I want to say this again, $5,000 a year in after-tax dollars. So employers can also contribute up to $2,500 to an employee's account, which also wouldn't be counted as income to the recipient. Both caps will be indexed to inflation. So the balance will be invested in only, I thought this was interesting, low-cost fund accounts that tracks the U.S. stock market index, the S&P. Very smart. And also they prohibit any investment in bond funds. So this has got to be pure growth. Some interesting additions. Okay, withdrawals from a Trump account will not be allowed until the beneficiary turns 18. After that, it'll function kind of like an IRA with tax-deferred growth until 59 and a half. Early withdrawals will be permitted penalty-free for some qualified expenses, such as educational costs, up to $10,000 for first-time home purchases or to start a business. I thought that was interesting. So those are the rules for withdrawing funds.
So, Brad, also in the one big beautiful bill, there's the no tax on tips. There's a no tax on overtime. Trump is trying to get no federal tax on Social Security, which is, in theory, why they do this, the standard deduction of $6,000 per person over the age of 65, or that they added in for single people. I mean, it's kind of an interesting thing. But all of those three, the standard deduction bump, the no tax on tips, and the no tax on overtime, those also expire after 2028, right?
Yeah, you nailed it. In fact, that's what I was going to mention, is that like most tax law that gets passed, there's a lot of give and take, right? And some people view this as a feature of our democracy. Others view it as a bug, that you never get your perfect bill. You get kind of this watered down version that for people like, half the people don't. And perfect example there, you were talking about you mentioned the no federal taxes on tips and overtime. Some people might have viewed in the past taxes on tips and overtime as regressive, where that means that it hurts someone to be taxed on dollars that they have fewer dollars. So like 10% of $10,000 of income would hurt someone more than 10% of someone that has $100,000 of income or $1 million of income. It's the same dollar percentage, but it hurts more. And so one of the ways that this bill made it through was trying to remove some of the more regressive aspects of our tax code. So, for example, as I was saying, the removal of tips and overtime, or taxes on tips and overtime wages on federal tax returns. It's one that I recognize is not going to affect most retirees directly, but if you or a family member, or even if you did take some part-time work or something like that, if you're a family member is still working, especially in the areas like service or hospitality, that's a pretty solid tax break to be aware of. So that's one that I know hopefully is part of the reason that it got pushed through and was more bipartisan enough to make it through our government. I think the bottom line with the big beautiful bill is that it offers real tax relief. And again, while it wasn't without controversy, it did end up getting pushed through into law. The real tax relief comes through higher deductions, some pretty innovative ways to help the next generation, the child tax credit and the $1,000 being deposited into new kids' accounts for the next few years. But like most tax laws, these changes are going to be temporary, like you said, Mark. Between 2028 and 2030, you're going to have a lot of these tax laws fall off. And to be clear, this is very strategic. It's a way to get a bill through Congress all the way through to it's signed into law by the president, because there just has to be some give and take. And so through the next 3 years, we should be able to expect this law to set the standard for what taxes are going to be for the time being. But by about 2030, a lot of this is going to be reversed. And so I think what I would just tell people is this is a perfect time to raise the bar when it comes to what you expect in the form of advice from your financial advisor, fiduciary, or even all the way down to your CPA. A lot just changed. And you should have your portfolio and your overall tax strategy, the withdrawal rate from your portfolio, the techniques that are used to build your retirement plan. You should be looking at all those different aspects of working with a good fiduciary through a different lens, given major tax changes like this. It doesn't happen all the time, and this one just came through. So make sure you're getting those phone calls.
So you can always call the team at Decker Retirement. Talk about this, 833-707-3030. There's a lot of tax stuff in there. There's the child tax, the no tax on tips, overtime, all that kind of stuff, the big bump in standard deductions. There's a lot going on. And so one of the opportunities you have is to talk with the team at Decker Retirement and figure out how this all affects you, because it should affect a lot of it in a positive way. But if you have somebody that can really help guide you, 833-707-3030, no cost, no obligation, no pressure. Take advantage, 833-707-3030. Brian, Brad, enjoyed it. We'll do it again next week.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Uncle Sam might need a loan soon from you. We have over $36 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.